Ryan buys a rental property. Brandon puts the exact same money into index funds. They both think they made the smarter choice. They're both wrong. Because Ryan forgot to count the hours, and Brandon forgot to count the zeros on the other side of leverage. And when you run the actual numbers, not the napkin math, the real math, over 20 years, what you find might be the most uncomfortable thing you've ever seen in a finance video. So let's do this fairly. Both sides, all the costs, no agenda. Before we touch a single number, I want to be clear about something. I've seen these comparison videos. Half of them quietly give stocks every advantage and quietly give real estate every problem. I'm not doing that. Both sides are going to get hit with the same honesty. Here are the rules. Ryan and Brandon both have $60,000 saved. Both earn $65,000 a year. Same city, same age, same credit score, same financial starting point. The only difference, the only one, is what they do with that 60 grand. Ryan uses it as a 20% down payment on a $300,000 rental property, a solid 3-bedroom in a decent neighborhood. He takes out a 30-year mortgage at 6.8% interest. His monthly payment comes to about $1,570. He finds a tenant willing to pay $2,100 a month. On paper, that's $530 a month in profit before he spends a dollar on anything else. Ryan feels like a genius. Brandon takes that same $60,000 and drops it into a total stock market index fund. No tenants, no keys, no story to tell. He sets up an automatic $400 monthly contribution and doesn't look at it again. On day one, Ryan has a property, a tenant, and something to talk about. Brandon has a brokerage account and a confirmation email. It's not even close in terms of how it feels. But feelings and math are two very different things. For the first year, Ryan is living the landlord dream. Rent hits his account on the first, he drives past the property on his lunch break and thinks, I own that. He's claiming depreciation on his taxes, shaving real money off his tax bill. He's building equity. He watches comfortable homes tick up in value. Everything about this investment feels smart. Brandon logs into his account once a quarter, see the number go up a little, down a little, then up a little more. Year one, his $60,000 grows to around $66,000.
Year two, maybe $73,000. It doesn't feel like anything is happening. There's no key in his pocket, no asset he can point to from a car window, just the number on a screen. Ryan's friends ask him about the property. Brandon's friends don't ask him about anything. Now let's look at year three. Ryan has collected roughly $75,600 in rent. His mortgage payments total about $56,520. That leaves $19,080 in gross cash flow. Sounds good, until you subtract everything else. Property taxes, about $3,600 a year. Insurance, $1,800. He replaced a water heater for $1,400, had a small plumbing issue that cost $900. 1 month of vacancy between tenants, that's $2,100 in lost rent, plus $700 to clean and relist. And he manages the property himself to save money. That means 10 p.m. texts, weekend showings, and coordinating a roofer on his lunch break. After all real costs, Ryan's actual net cash flow over 3 years somewhere between $2,500 and $5,000, not the $19,080 that looked so good on paper. Brandon, who has done absolutely nothing, is sitting at about $88,000. He spent 0 hours managing anything. The rent check is the number everyone talks about. It's the number on the YouTube thumbnail, the number at the real estate meetup. What nobody talks about is everything that comes out before you actually keep any of it. Vacancy. The average rental property sits empty about 1 month per year. Not a disaster, but it's a full mortgage payment with 0 income to cover it. And when a tenant leaves, you're paying for cleaning, repairs, and your own time to screen replacements. Maintenance. The rule of thumb, budget 1 to 2% of the property value annually. On a $300,000 house, that's $3,000 to $6,000 a year. Some years, it's a $150 faucet fix. Other years, it's a $9,000 HVAC replacement you didn't see coming and can't postpone because it's August and your tenant is ready to walk. Capital expenditures. Roofs last 20 to 25 years. Furnaces, 15 to 20. Water heaters, 10 to 12. These are guaranteed future costs. They arrive in chunks of $5,000 to $18,000. If you're not setting money aside for these every month, you're not running a business, you're running on luck. Property management. If Ryan hires a manager, that's 8 to 10% of monthly rent, roughly $170 to $210 a month, gone immediately. If he manages himself, he's working a part-time job he doesn't get paid for. Either way, it costs something.
And then there's the risk nobody likes to put in the video description. A tenant who stops paying and knows the eviction process can cost 3 to 5 months of lost rent plus legal fees. That single event can erase an entire year of profit or more. None of this shows up in the $530 per month cash flow number, but it shows up eventually. By year 5, Ryan is deep in the reality of being a landlord. He's on his third tenant. He replaced the roof for $9,200, dealt with a plumbing emergency. He had 1 month empty. He's raised rent to $2,350, which helps, but his property taxes and insurance went up too. His cash-on-cash return, the money he actually pockets relative to what he put in, is hovering around 3 to 5% after all real costs. Not bad, but not the 15% he told his friends about at the cookout. Brandon is still doing nothing. By year 7, his portfolio, with $400 monthly contributions and roughly 10% annual returns, is sitting at approximately $165,000 to $180,000. He hasn't picked a single stock. He hasn't timed a single market move. But here's where Ryan still has a card nobody talks about: leverage. His $300,000 property has appreciated 3 to 4% a year and is now worth around $360,000 to $375,000. His equity, the difference between what it's worth and what he owes, has grown to roughly $90,000 to $105,000. That's real wealth, and it came partly from the bank's money. That's the power of leverage, and it's the one advantage index fund investors genuinely cannot replicate. If I only showed you the hidden costs of real estate, I'd be doing exactly what every stock market influencer does. So let's be honest about what stocks can't do. Volatility is brutal. In 2008, the market dropped 37%. In March 2020, it fell 34% in a single month. If Brandon had $180,000 in his portfolio and watched it drop to $115,000 in a few weeks, that's not a number on a screen. That's visceral. And the data shows most retail investors panic sell during crashes and buy back in after the recovery, locking in losses at the worst possible moment. No cash flow. Index funds don't send you a monthly check. Dividends on a total market fund run about 1.5 to 2% yield. On $180,000, that's roughly $225 a month. That's not replacing anyone's income. No leverage. Brandon used $60,000 to control $60,000 in assets. Ryan used $60,000 to control $300,000 in assets. That 5-to-1 leverage is the reason real estate builds more millionaires per dollar invested than almost any other asset class. When prices rise, leverage multiplies the gain. And depreciation. Real estate investors can deduct the theoretical decline in their building's value from taxable income, even while the property actually appreciates. That's a legal tax shelter stock investors simply don't have. Real estate wins when the rent-to-price ratio is strong, meaning monthly rent is at least 0.8% of the purchase price. When you treat it as a business, not a side hustle. When you use house hacking, living in one unit, renting the others, and reduce your own housing cost to near zero while building equity. The stock market genuinely cannot do that.
Now let's go to year 20, the number you came here for. Ryan's property is worth roughly $540,000 to $580,000. His mortgage is paid off or nearly there. His equity sits somewhere between $480,000 and $540,000. He's been collecting rent the whole time, But after 20 years of maintenance, turnover, repairs, taxes, insurance, and one major renovation, his total net profit from cash flow might be $50,000 to $90,000 above what he spent, maybe more in a hot market, maybe less in a flat one. Brandon's portfolio at 10% average annual return with $400 monthly contributions, approximately $490,000 to $530,000. His total contributions over 20 years, $156,000. The other $340,000 plus is pure compounding. No debt, no tenants, no 3 a.m. pipe emergencies. When you compare total net worth, they're in the same neighborhood, somewhere between $480,000 and $540,000 each. But how they got there is completely different. Ryan worked for him. Brandon waited for him. Ryan had stress, debt concentration, and illiquidity. Brandon had volatility, but also liquidity, freedom, and his weekends back. And here's the part that changes the math dramatically. If Brandon increased his monthly contribution by just $200, bringing it to $600, his 20-year portfolio jumps to roughly $620,000 to $660,000. Because in the stock market, increasing contributions has a multiplied effect through compounding. In real estate, the same move usually means buying another property, taking on another mortgage, and doubling the workload. Real estate isn't a bad investment, it's a misunderstood one. Ryan and Brandon both walked away from their decision thinking they were making the smart play. Ryan thought real estate was the proven path to wealth. Brandon thought the market would do the work for his. Neither of them actually sat down and mapped out what the choice costs in dollars, in time, in stress, and in risk. Over 10 or 20 years, the real trap isn't real estate, and it isn't stocks. The real trap is picking either one based on a YouTube headline, a podcast clip, or something your uncle said at a family dinner, without ever running the full numbers for your actual situation. And if you're wondering what happens when you do both, when you own property and invest in the market at the same time, and use the rental income to fund the contributions, that's a completely different conversation, and the math might change everything you think you know. But I'll save that for the next one. For now, the next time someone tells you real estate always wins, or the stock market always wins, ask them one question. Did you include everything? Because the answer that includes everything is the only answer that matters. What would you choose with $60,000 today, a rental property or index funds? And be honest, are you actually counting everything? The time, the repairs, the vacancy, the volatility, the debt, the opportunity cost? Drop your answer below and tell me if your thinking changed after seeing the full math.